Hello, good morning all of you. Myself Dr. Ibha Rani. In this video, I will be discussing about what do you mean by risk and what are the types involved in the risk. The first one is what do you mean by risk? Risk is in terms of finance, as an investor, you should understand what are the risks and what are the types of risk involved when you are going to invest in any investment options. So in finance, risk is the probability that actual results will differ from expected result. It means that as an investor, you have invested maybe in gold or maybe in another securities, and you are expecting that your return will be 10%, but after 1 year the return is not 10%, maybe it has been 15%, if it is maybe 8%. So there is a variation what you have expected and what you actually got it. In the capital asset pricing model, that is CAPM model, risk is defined as the volatility of returns. Volatility is talking about the changes, the variation in the returns what you will be getting it. When there is a saying, always the risk will be trade-off will be balanced by the return. As an investors, if you having the high uh, capabilities to take the risk, the chances of return will be also high. There is a balance. Risk will be coming with the compensated, high risk will be compensated with the high return. Low risk, there are different investment options are available. Start with no risk and ends with high risk. Low risk means treasury bills, the safest investment options, but the return also will be low. But when you are going for the highest risk taking capabilities, you are coming under the high risk taking capabilities, then you can go for the securities share market, you can invest. So here you can see in this graph, it will be the risk is this side, return is on y-axis, and how the risk will be increasing, the chances of return is also will be increasing. Now we will be looking into that the types of risk involved. In investment, mostly the risk has been categorized into two basic categories. One is systematic risk, one is unsystematic risk. So first we look into that what do you mean by systematic risk and what do you mean by unsystematic risk. Systematic risk is talking about, it is also known as undiversifiable risk. It means that you know that in investment, risk will be eliminated or avoided by the diversification of your portfolio. So here in systematic risk, but you cannot avoid the systematic risk. These are the impact of the systematic risk is the large number of securities associated with the entire market or segment. How much analysis you are doing, it doesn't matter. You have to, as an investor, you have to bear with the systematic risk, which is unavoidable risk. You cannot avoid systematic risk. While unsystematic risk is, it is restricted to a specific industry, segment or particular company. Maybe it will be the something happened in ABC Limited company. So unsystematic risk only can be avoided. So unsystematic risk is also known as the diversifiable risk or you can avoid unsystematic risk. But as an investor, you cannot avoid systematic risk. That nature, it cannot be controlled because it's not in the hand of the investors. It can be minimized or avoided by a business management, but unsystematic risk can be controlled, it can be minimized or even avoided by a business management. How you can avoid? By diversification. Do not put all your eggs in one basket. You can diversify your portfolio with different investment options and you can avoid it. Factors which influencing both the risk, systematic and unsystematic risk. So external factors or macroeconomic factors which can influence the systematic risk, including all your economy, your political, your sociological, whatever the factors which can influence the external factors, that will be the systematic risk. It will be unsystematic risk will be related to the microeconomic factors which will be impacting only that particular industry, particular company. So if a problem is there in ABC Limited company, you don't want to purchase the ABC Limited company shares, you can purchase the XYZ Limited company. So you can avoid it. Then protection, it is the allocation of assets, and unsystematic risk is the diversification of your investment portfolio. Avoid, already I have discussed about, it cannot be avoided. As an investor, you cannot avoid systematic risk. Only as an investor you can avoid unsystematic risk. There are different types of there, and that is the in systematic risk it will be purchasing power risk, it is market risk, it will be interest rate risk, which cannot be avoided. While unsystematic risk is related to that particular company, maybe business specific problem, their financial risk will be there, their credit risk will be there, that you can avoid it. So I hope you understand this risk and types of the risk. Thank you all.